All right, so I'm just going to walk through it. I'm going to do it because you have to do this. You don't get to use a computer, so I'm gonna write it out the way you would do it on the exam. So without Excel, so I'm not going to do anything in Excel. I have Excel open with the answers on another machine. So let's first look at what we're supposed to do. Here we're supposed to justify beta and get a discount rate. So justify beta, remember there's 4 steps and you want to write these 4 steps out. You've got sensitivity, revenue sensitivity, operating leverage.
Does it have to be in a certain order, or is it okay?
Well, it makes sense in this order.
Okay.
You could certainly switch the operating financial leverage, but I would generally do it, but it doesn't have to be. All right, so here we're talking about Best Buy. Best Buy, it's retail, it's higher, it's electronics. So clearly a consumer discretionary, I can never spell the word discretionary, company selling higher price, durable goods. So beta, well, above 1. I'm not necessarily saying above 2 or even 1.5, but somewhere probably in the 125 to 170 range. They sell, especially now, they're becoming much more of an appliance sales person, but electronics, you just see those are durable goods. So above 1. Operating leverage, I would assume much hourly workers, so reducing fixed costs some, though the real estate and depreciation will increase fixed costs. I assume, now I don't know for sure, but I assume they own their stores, that they're not leasing from some, I mean, it's possible. But then looking at the net margin standard, make sure you say margin standard deviation. I had another class with an exam like this, and they said their net margin was high or low. That's not what it is. It's the net margin deviation. Ranks in the top 10%. Actually, 8% rank for having very low volatility. Therefore, I will assume low operating costs. Makes sense. A lot of retailers like this, if their costs go up, they can raise their prices. They don't have a lot of fixed costs because most of their salaried employees, most of their employees are hourly. So it makes sense. This is, and a lot of retail shops like this, even if they're discretionary, they tend to have fairly stable margins, mainly because they're a margin business. That's what they manage. Financial leverage, lower than average debt to equity. Further, now do say, so pushing beta down closer to 1, put that in your answer. Further pushing beta down closer to 1. So it's a cyclical company, it's discretionary, definitely a high beta company, but very stable margins, lower than average debt. So we could probably get away with something in the 125 or so range. And then we look at the history. The history is all over the place. I'm going to look more here recently. You can definitely justify, 130 to 150. This looks unusual to me. So if you just look in the last several years, the median's probably in the 125, 150, anywhere in there sounds fine. So suggest 1.3 to maybe 1.7. All of the above is consistent with a 1.50 beta. You know, there's no right answer. There are definitely wrong answers. A beta of 0.2 or 0.5 would be wrong. A beta of 6, 3 or 4, even above 3 even. It never been above 3, and 2.5 would be pretty extreme. So, you know, to me, a 2 or higher beta, that's a high debt ridden auto manufacturer or something like that. So I'm going to go with the 1.5 beta. And so the discount rate is the risk-free rate plus beta times the market risk premium. So risk-free rate, we just have to read it. The current 10-year treasury is 158, but your boss believes this rate is too low. That's unlikely that's going to be the case on the exam, and so uses the forward curve. I mean, it just tells you, she uses the forward curve. The forward curve is 270. It makes it really simple. The risk-free rate is 270. Make sure you convert everything into percents. I have students that take 2.7%. They convert it to 0.27. It's 27%. So that's obviously wrong. And then you have your expected return on stocks. It's going to equal the dividend yield plus maybe the buyback yield plus expected earnings growth. Expected earnings growth is a function of economic growth, which equals productivity growth. Y'all did this on paper 3, so you remember all of this, plus labor growth plus inflation. And then the market risk premium equals expected return on stocks minus the risk-free rate. So here, let's see what she gives us. She expects long-term nominal growth to come from 2.75 productivity, 0.0025 of labor growth, and 0.025 of inflation. And that equals 0.055. For the market premiums, use the implied approach, assuming a dividend yield of 0.14. I'll see where I'm getting the numbers. Here's the 3 numbers for the economic growth, 0.14. Best Buy's dividend yield is 2.3, but you don't care about that. That has nothing to do with market risk premium. And assuming normal corporate earnings growth to be in line. She didn't give you anything on the buyback yield, so you ignore that. We're being line with overall economy, though higher than the 4.5. You don't care about this. We're not looking, when we're doing the market risk premium, we don't care about Best Buy. That comes in when we value Best Buy. But at this point, the only thing that affects Best Buy in this formula is the beta. So we got 0.014 plus 0.055. That gives us expected return on stocks of, I gotta find that, 0.069. So the market risk premium is 0.069 minus 0.027 equals 0.042. And Ross and Jason, I don't know if y'all worked the problem in advance, but let me know if you got a different answer on any of these. But when I put all that together, I'm going to double check here, just make sure. So 0.027 plus 1.5 times 0.042. Nice, gives me a really nice round number. Right? That looks like a lot, and you have to do it off the top of your head because it's an exam, but you also need to be able to do off the top of your head in practice. You just need to know this the rest of your life. How do you come up with the discount rate for a stock? You need to have some process. I'm giving you a process here that's perfectly reasonable. Other firms might have different processes. Some might probably even use just the regression data from Yahoo Finance, which I think is always wrong, but I get 0.09 or 9%. So any questions on that? There's the full answer. There's my beta. And there's my KE. So those are the two things we asked for, right? Determine their beta and determine their equity discount rate. So there's their beta, there's their equity discount rate. All right, I'm going to move on to number 2 unless someone stops me. So we'll use the 9%. Now you may not get the same answer. I would recommend that if you get like 14% or 4% on question 1 and question 2, I'm giving you 9, you might just double check for math errors because there's a chance you probably did something wrong. You're probably going to have a beta that's wrong because most students are going to use a beta pretty close to the median. That's pretty typical. And all the other numbers are given, so you shouldn't get different answers. So if you got 14% or 5%, you probably did something wrong, so you can double check. All right, so here we just do the formulas. It's very straightforward. You got the dividend discount model, the H model, the capitalized earnings model. So dividend discount model, you take dividend 0 times 1 plus long-term growth divided by KE minus long-term growth. H model, you take all of that, exact same thing. And if I were you, I would write out the equation on the exam and then fill the numbers in. Show me all your work, because if you get a wrong answer, you don't show your work, I can't give you any credit. But if you get the wrong answer and I see you just have a math error, I'll definitely give you credit. So in the H model is the same thing. We start with dividend 0 plus 1 plus long-term growth, and then we take that, add dividend 0 again, times something called H, times short-term growth, minus long-term growth. And then the capitalized earnings model takes earnings per share 0 times 1 plus inflation. Looks a lot like the dividend discount model. It's just we use earnings per share instead of dividends, and we use inflation instead of long-term growth. So let's just plug the numbers in. Dividend 0, you can see that up there is 2.42. Long-term growth is 1 plus 0.05. We divide that by 0.09 minus 0.05, and you should get 5620. Someone might check my math just to make sure. I hate having typos in a video. For the H, is that what you got, Ross?
Yeah, I got the same.
All right, good, good. All right, and then here's the exact same thing again. So we can just, you can't do this, but I can do this. Oops. 242 times 1.05, 1 plus 0.05 plus 2.42 plus. All right. So your boss expects earnings to grow at 10% next year and get down to the 4.5% over 6 years. So that makes your H 3. It's whatever half of that is. So if I say 6 years, your H is 3 times your short-term growth is going to be 10%. Your long-term growth is going to be 4.5%. When I do all of that, I get 65.07. Hopefully y'all are getting that too. And then on cap earnings, you got it, Ross? Or who was it?
Yeah, I got
the same thing.
Okay. All right, keep me honest here. All right, and then this one, 684 times 1 plus 0.025. That's our inflation number up there. Divided by 0.09 minus 0.025. And here I get 107.86. All right. So if anyone didn't get any of that, didn't get those, let me know. If you did get them, let me know too, so I'll feel a little more comfortable.
I got this one for that one.
All right, so we're good all the way down. Good.
Mhm.
Yeah, sounds like some of y'all worked the exam in advance. That's great. That's what you want to do. All right. Question 3. Here we're going to value the bond. So let's get our KD first. KD is going to be risk-free rate plus a spread. All right, so well, look, it's almost always going to be a 2-year bond just because you're doing this by hand. So it's a 20-year bond issued 18 years ago. So our risk-free rate is going to be 0.0026, this 0.26%, but you type it as in a decimal. And then our spread, it's rated A minus today, but it was rated AAA plus, but all we care about is today. So 2 years and A minus, that gives you 96. So plus 96 divided by 10,000. And that should get you 0.0122. That's our discount rate. Then we got to get the effective yield, which here is not going to make much difference, but the effective yield is going to be 1 plus 0.0122 divided by 2, raised to the second minus 1. Yeah, it's essentially the same number again. But 0.012237. I don't know how many decimal places you want to go out, but I worked my answer in Excel. So, and then the cash flow is going to be the face times the coupon divided by 2 because they pay twice a year. So we're assuming $1,000 face. So here has a coupon of 8%. So times 0.08 divided by 2 equals $40. So let's do 1, 2, 3, 4 columns and 5 rows. So we got time. You have to have this table on your paper, I mean your exams. So cash flow, discount factor, and discounted cash flow. So time is 0.5, 1 year, 18 months, and 2 years. Our cash flow is going to be 40, 40, 40, and then remember at the end you get your $1,000 back. So there's our cash flows. Our discount factor is going to be 1 divided by 1 plus the effective rate raised to the time. So I'll just do the first one. It's going to be 1 divided by 1 plus 0.012337 raised to the 0.5. And when you do that, you should get 0.9939. Here you raise it to the first power, and you should get 0.09879. Raise it to the 1.5 power, 0.9819. The last one, 0.976. Oops. 9760. And then here you just multiply across 40 times 0.9939. That equals 39.76. Same thing here, 40 times 0.9879. That's going to equal 39.52. 40 times 0.9819 is 39.28. And then the last one, 1,040, it's going to be times 0.9760. And you add all that up, the sum of the discounted cash flow should equal, I get 1133.56, or with rounding, depends on how much you round. You could get as high as 1133.60, but rounding doesn't matter. So any questions on that? Anybody else get that answer?
Yes, sir. I got the same.
Okay. Now just be careful. I don't know if you did it in Excel, make sure you do it by hand, okay? That you can do it without the Excel phone. You can check these on your calculator, I have no problem double checking. Just make sure you show all your work. I'm more interested that you know what your calculator is doing, then that you know how to actually use your calculator, because you won't ever use a calculator again once you graduate. All right, there's the third question. The next one, pretty straightforward, a lot of calculating, but it's a good exercise. So we're going to say a holding period return equals any market value minus beginning market value plus accrued income divided by beginning market value. So for January, February, March, we're not going to actually do January, excuse me. So for February and March, so for February, you're going to get, now when does this dividend happen? X date. So the dividend's only going to be in March. All you got to do is look at the X date. And you know you're going to have 7 cents of accrued income just in March, but everywhere else you don't. So the ending market value in February is 100.35. Beginning market value is 108.82. Divide that by 108.82, and you should get minus 7.78%. For March, get ending value of 114.81 minus 100.35. Here's where you add the 7 cents divided by 100.35, and I get 14.48%. And then for April, 116.27 minus 114.81 divided by 114.81, and I get 1.27%. Hopefully y'all got those numbers. So there's a holding period returns, then you got to do the average. So their arithmetic is going to equal minus 0.0778 plus 0.1448 plus 0.0127 divided by 3, and I get 0.0266. Annualized equals 0.0266 times 12, because this is monthly, and that gives me 0.3187, and then you put a little asterisk there. CFA Institute. Come on, Bill Gates, I don't want that. CFA Institute does not allow periods less than 1 year to be annualized. And then the geometric, a little bit more difficult work here. So here you take, make sure you got your parentheses right, but 1 plus the first period is actually a negative, so 1 minus 0.0078 times the next period, 1 plus 0.1448 times the last period, 1 plus 0.0127. You take all of that, you raise it to the 1 over n. In this case, there's 3 periods minus 1. When I do that, you have to get something that's less than 266, and sure enough, I get 0.0225. And then the annualized, it's going to be this exact same thing again, except for instead of doing 1 over 3, it's 12 months. To annualize, we do 12 over 3, and when we do that, we get 0.3065, which can be higher than the annualized arithmetic average. All right, hopefully y'all got those answers.
You have a minus on the geometric on the first operation. You have a minus. Is it
Minus where?
One minus 0.0778.
Yeah, because they lost money.
Okay, okay, gotcha.
Yeah, if they lose money, you got to do the minus sign. Yeah, they're all on the exams. There's a lot of math errors on this part. So write out all your answers. You might get pretty close to full credit if you do that. All right, I don't know if anyone can confirm those answers. Hopefully they're right.
Yes, I got the same.
Good.
Yeah, same.
Don't forget the little footnote. It doesn't cost you much, but why throw away easy points? All right. The next one is just a written problem. So your boss is looking at a retail. So the first thing we do, let's figure out what's wrong. So you want to write down each one of them. So I would rewrite them all. So EV, you don't have to write it out entirely. EV to EBITDA. I would start off with ratio is fine, but more used with high growth companies such as in tech. So the revenue based ones tend to use the EV, the EBITDA, EV, the EBIT, those kind of things. Price to revenue ratio is in error because revenue is before interest expense, so belongs to both stock and bond holders, while earnings is after interest expense, so belongs only to stockholders. Something along that line. So kick that one out. Price to book value ratio is fine, but more used for commodity driven companies, financials, and industrials. You don't have to go into detail on why, commodity driven because of volatile earnings, price to book value, smooth out those earnings, financials because they're focused on return on invested capital, industrials because they have a lot of property, plant, and equipment. You don't have to explain all of that, but it's good to know that. If you want to combine, you can. So EV to EBITDA and PEG ratios are fine, but more used with high growth companies such as technology. The next one is EV to revenue. Ratio is fine and the most appropriate for a retailer like Best Buy focused on margins. And then price to earnings ratio is fine and used for all industries. There's really no industry that, but here your final answer is it's going to be the EV to revenue. That's your full answer. Again, this is the most missed question on the exam. I'm not sure why. But you understand this is pretty critical in your interpretation of numbers. All right, no questions on that. We'll jump on here. And the last question, I mean, it's only 7:30. You've got essentially 2 hours to do the exam. So, all right, so remember on this one, this is a call. So a call, the intrinsic value going to equal the max of S minus X comma 0. And the gain is going to be the intrinsic value minus the option premium. So the gain is going to equal the max. So in this case, has a strike price of 130, so minus 130. It's trading at 145. So that's going to be $15 minus the option premium. What is our option premium? So we're buying the option, so it's going to be 620. And that should give you, I guess I could do that in my head, like 880 or something. Yeah, 880. Anybody confirm that? Did y'all get that one? Uh-oh. I'm not hearing any feedback on that one.
Yeah, I got that.
Okay. Second one on the put, the exact same thing again, isn't it? Just one little minor change. And that is we do X minus S. So the gain is the max of the strike is 125, stock is 115, so it's worth $10, and our premium, again, we're buying, so 1160. So we would have had a loss. Make it real clear on the loss. It's a loss. I don't know how to make it more obvious. I have students that like to put dashes before all their answers, and boy, that's really confusing because it's like, is that 880 or negative 880? So try to make it, you know, if you really want to be explicit about it, I would even say that is a loss of $1.60, or that is a gain of 880. If you want to just make it really clear, but make it really, really clear.
Later, I'm gonna go to my friend's house, Brandon.
Wait,
I'll go to Brandon's later.
Jason, you're gonna need to mute there, man. Thanks. All right, so if you're using any kind of strange marks, then, you know, make sure I'm real clear on that one. All right, the next one's a covered call. So covered call, you're going to own the stock and short a call. So the gain's going to be gain on the stock minus max S minus X comma 0 minus the option premium, all of that in parentheses. So here you gain on stock. So the stock started at 122 and now it's worth 145. So the gain on the stock is 145 minus 122. So you made $23 there, minus the max of, so the stock price is 145 minus the strike 130 comma 0 minus, and here we're selling the calls, so you got to do the 590 minus the 5.90. So that equals 23 minus, so 50, what is that, 910? Hopefully, does that sound right?
Yeah.
23 minus 9.1 gives me 1390, and that's the answer I got. So and again, you might be better off to say gain or loss, so it's real clear, so there's no confusion there. That's actually, that question is actually not missed as much as the relative value question. And then the last one is the time value. So we know that time value equals option premium minus the intrinsic value. So the intrinsic value, here we're talking about a put option. It's going to be the max of the strike minus the stock, comma 0. Don't get the intrinsic value mixed up with the gain. The gain is the max X minus S, comma 0 minus the option premium. I mean, the intrinsic value doesn't have the minus the option premium. So the gain is max X minus S, comma 0 minus option premium. The intrinsic value is just the max X minus S, comma 0. So in this case, we got max. Our strike is 125 minus the stock started at 122, comma 0. So that means our intrinsic value is 3. So the time value is going to equal 1160, which is the option price, minus 3. And that should equal 860. You might get that. That one's a pretty heavily missed one as well. Can you may confirm those? Well, it's one in my spreadsheet, so hopefully my spreadsheet's correct. And that's it. Boy, it took us only 35 minutes to do that, so it's not a real long exam. Questions on anything? All right, so
Professor
that's
Sweet,
it. Unless you,
I have a question on question one for the beta for the sensitivity. Can we also specify if it's if we think the company is cyclical or defensive? Because that helps me
Yeah.
to also determine.
yeah, you can certainly say consumer discretionary / cyclical company. That's certainly, yeah, it's probably good to get the words defensive and cyclical in there. That's a good point. I do like that. Knowing that cyclical means above one and defensive means below, use the jargon of our industry. That's a good thing to get in the practice of doing. Anything else?
I'm done. I'm gonna go ahead and log out. Thank you, Professor.
All right. I'll put this Word document and the video out there maybe tonight. So, all right. Thanks, everybody.